After the central bank fireworks of the past 2 weeks, with cuts from the European Central Bank and the US Federal Reserve, a studious pause in reductions to the Bank of England, and in increases from the Bank of Japan, we have a bit of a lull until earnings season starts on both sides of the Atlantic. However, the coming week should be no less informative for that, and from a corporate perspective, the focus will be on consumer staples, food and drink in this particular case, with a trading statement from Greggs on Tuesday the 1st of October, a first half set of results from Tesco's on the 3rd, and full year figures from Pubs Group JD Wetherspoon on Friday the 4th. Now, all three provide us with staple basic needs in one way or another, and all must balance input costs, staff, utilities, raw materials and ingredients, against pricing to protect margins but do so without jeopardising volume, and thus provide that concept of value to their customers in what remain highly competitive markets for takeaway food, groceries and eating and drinking out. Shares in Greggs are up almost by a third in the past year, and they're almost back to late 2021's all-time high. July's first half results were very strong, and investors will be hungry for more when they assess this third quarter update. Useful benchmarks to bear in mind here are the 7.4% like-for-like increase in sales in the first half, with total sales up nearly 14%. For the year, analysts expect total sales up 12%. The 16% increase in underlying pre-tax income in the first half, despite input cost inflation of 4 to 5%, which management is looking to offset with price increases. The first half's 51 store openings, net of relocations and closures, on the way to this year's target of 140 to 160. And the strong trends in evening sales and delivery and click and collect, where app traffic represented 18% of store transactions. Now, should management comment on full-year profits at all, the current consensus is for underlying pre-tax income of £186 million this year, compared to £168 million last year. That's an 11% increase, but does exclude the £21 million exceptional gain booked last year that related to insurance claims for business interruption during the COVID outbreak. Now, Tesco shares, they're also up strongly in the past year by a third, and that's to their highest level since late 2013. They've been helped by the woes of Morrisons and Asda, which are struggling under the debt burden shoveled onto them by their private equity buyers. Tesco's picked up a precious half point of market share over the past year, according to Kantar World Panel. That's fed into 3.6% like-for-like sales growth in the UK in the first quarter of this year, and 3.4% in retail across the whole group, and analysts will look for the second quarter trend here. After that, attention will turn to operating profit, where Chief Executive Ken Murphy offered guidance for this year of, quote, at least £2.8 billion on an underlying basis from retail, and analysts have penciled in £2.9 billion for a 4% increase with a contribution from Tesco Bank on top. A year ago, Tesco's first half adjusted operating profit was £1.4 billion from retail. Now, Mr Murphy has maintained the target of generating between £1.4 and £1.8 billion a year in free cash flow, and that helps to fund cash returns to shareholders. Tesco is running a £1 billion share buyback, and consensus estimates suggest the grocery giant will raise its full-year dividend to 13p a share from 12.1. The first half payment a year ago, by the way, of a benchmark, was 3.85p a share. Finally, at Tesco's, watch out for an update on the planned sale of Tesco Bank to Barclays, a deal that's expected to close towards the end of the fiscal year and release around £1 billion in cash in the process, capital that the company plans to return to shareholders. Last but by no means least, JD Wetherspoon shares are broadly flat over the past year, even though the Pubs Group, with an estate of around 800 sites, is expected to report record sales for the full year to July 2024. The issue, therefore, is one of profit, where increased wages, utility bills and interest costs on the company's £670 million net debt position are all having an impact. July's trading statement saw Chair Tim Martin note that full-year results would be in line with expectations, and analysts currently expect sales of just over £2 billion and pre-tax income of £72 million, compared to £1.9 billion and £43 million a year ago. As such, more attention may focus on any comment on like-for-like sales in the early stages of the new financial year, compared to the 7.7% run rate in fiscal 2024, and also again on input costs and margins, as well as ongoing development of the estate. For fiscal 2025, consensus forecasts currently stand at £2.1 billion for sales and £84 million for pre-tax income. Note the company hasn't paid a dividend since 2019, at which point the pandemic broke out, but it did run a £40 million share buyback programme in the first half of the current year. I hope that you and your families are all well and in good health. Thank you for watching, and I look forward to seeing you again next time.